Welcome back to the deep dive. We have a really fascinating set of documents on the table today.
Yeah, we really do. It's a fun one.
Because usually, when we look at earnings reports for the massive tech giants, the companies that effectively run the internet, the numbers tend to follow a certain logic.
Right.
Revenue goes up, profit goes up, revenue stays flat, profit stays flat. They usually they hold hands and walk up the chart together.
Exactly. It's usually a very linear relationship.
Yeah.
Stability and predictability are kind of the brand when you get to be a trillion-dollar company.
Right. But we are looking at Microsoft's Q2 earnings for fiscal year 2026. So that's the period ending December 31st, 2025. And the math, well, at first glance, it looks completely broken.
It really does.
I'm looking at the headline numbers here. Revenue is up a very healthy 17%.
Which is great.
That's great. But net income, like the actual bottom line profit,
Yeah.
it is up 60%.
It's a disconnect that really just stops you in your tracks when you read it.
It's massive. You don't usually see a company the size of a small country grow its bottom line 3 times faster than its top line unless something weird is happening. Like, did they stop paying their electric bill?
Right. Or fire half the staff.
Exactly. So that is our mission today for you listening. We are going to dig into the Form 10Q filing. That's the raw, unvarnished legal data they submit to the SEC.
Those real numbers.
The real numbers. And we want to figure out 2 things. 1, how did they manufacture that 60% profit jump? And 2, is the underlying business actually as healthy as that number suggests? Or is there a kind of tax hiding in the details?
And we absolutely have to talk about that AI tax you mentioned, because while the profits look explosive on the surface, if you read the fine print in the expense columns, there's a very expensive reality checking in.
Plus, we have to talk about the hardware crash. It's such a weird quarter.
Yeah, it's definitely a tale of 2 Microsofts in this filing. You have the enterprise software beast just roaring, and then you have the consumer hardware struggling.
Right. So let's start with the elephant in the room, the accounting magic. Set the scene for the numbers so we know exactly what we're dealing with.
Okay, let's look at the headline stats. For the quarter ending December 2025, Microsoft pulled in $81.3 billion in revenue,
Wow.
which represents 17% growth year over year. Operating income, and this is the money they make from actually selling software, cloud services, and ads, that was $38.3 billion. That's up 21%.
Which, to be clear, is fantastic. 21% operating growth for a company this mature is incredible. But then you look at net income, $38.5 billion.
Yep.
Wait, pause. For those of you listening who don't spend your weekends staring at balance sheets, let's clarify why this is so weird.
It breaks the normal rules.
It does. Usually net income is lower than operating income. You take your operating profit, you pay the tax man, you pay interest on your debt, and you're left with a smaller net income.
Right.
Here, the final profit is actually higher than the operating profit.
Which implies they made money from something other than selling products.
And they did.
They absolutely did. If you scroll down to the line item in the 10Q labeled Other Income Expense, net, you see a gain of $9.97 billion.
Let's just call it $10 billion.
Yeah, $10 billion just appearing on the ledger.
And last year, this line was a loss, right?
Correct. Last year was a loss about $2 billion. So this is a massive swing. And the filing is very specific about where this came from. It's the OpenAI effect.
Specifically, the OpenAI recapitalization. I feel like we need to unpack this because it sounds like jargon designed to bore people to sleep.
It does.
But it's actually worth $10 billion.
Right.
What actually happened in October 2025?
So OpenAI restructured to form a public benefit corporation. And as part of that process, there was a recapitalization event. Now, remember that Microsoft owns approximately 27% of OpenAI.
Right, they're the biggest backer.
Exactly. When OpenAI recapitalized, the valuation of the company ostensibly changed. And this triggered what accountants call a dilution gain.
Okay, hold on. Dilution usually implies losing value. If I get diluted, my slice of the pie gets smaller. It sounds bad.
Your slice gets smaller as a percentage, yes. But if the pie itself becomes 10 times bigger, your smaller slice is suddenly worth much more than your old, bigger slice.
I see. So even though the corporate structure changed, the value of what Microsoft holds went up.
Exactly.
Huh.
Because Microsoft accounts for OpenAI under the equity method, they had to recognize this change in value on their own books.
Yeah.
But, and this is the crucial part, it is a non-cash gain.
Meaning Microsoft didn't sell shares?
No.
And OpenAI didn't wire them $10 billion.
No, no cash changed hands. It's entirely a paper adjustment.
Yeah.
It's basically them stating, our asset is now worth this much more.
So it's like if I bought a house for $500,000 and suddenly the city rezones the neighborhood and the Zillow estimate jumps to $2 million, I'm richer on paper, my net worth is up.
Right.
But I don't actually have that cash in my pocket to go buy groceries.
That is a perfect analogy. And because earnings reports are a snapshot of value creation, that Zillow estimate increase gets added to the net income.
Ah, I see.
That is exactly why you see that wild 60% growth figure. It's asset appreciation, not operational efficiency.
It feels a little deceptive, doesn't it? I mean, not legally it's the rules, but for an investor or anyone trying to gauge the health of the company, that 60% number is kind of a mirage.
That's why you always have to look at the adjusted numbers. The 10Q is kind enough to provide the math, excluding that one-time event. If you strip out the OpenAI magic, net income growth is 23%.
Okay, 23% is still incredibly strong.
It really is. It matches up nicely with the operating income growth. It shows a healthy, growing business. But it is not the miraculous 60% explosion the headlines are screaming about. It's a very good quarter, boosted by a one-time accounting event.
So the miracle's accounting, but the health is real.
Exactly.
Let's pivot to what is actually driving that 23% real growth. The cloud. This is the engine room.
The juggernaut. The intelligent cloud segment revenue is $32.9 billion, up 29%. But the metric that matters, the one that really moved the stock price, is Azure and other cloud services.
That's the direct competitor to Amazon's AWS and Google Cloud.
Yep, and it grew 39%.
39% growth at that scale is just absurd. We are talking about a business unit that is already massive, growing like it's a brand new startup.
It's the AI wave. This is the direct result of the last 3 years of hype turning into actual contracts.
Yeah.
Every enterprise customer wants to integrate AI, and to do that, they need Azure. They need the compute power.
Right.
But it's not just Azure. The productivity and business processes segment, so that's Office, LinkedIn, Dynamics, that's also up 16%.
I noticed a specific detail in the commercial side of that. Revenue is up 17%, but the filing explicitly mentions revenue per user is increasing.
Yes.
That says to me they aren't just finding new customers, they are squeezing more money out of the old ones.
That is the upsell strategy in action. They are moving customers to E5 licenses, which is the premium tier, and getting them to add Copilot subscriptions. It's no longer just, do you want Word and Excel? It's, do you want the AI that writes the emails for you?
And companies are paying for it.
They absolutely are paying for it.
But here was the surprise for me in the filing. We always talk about Microsoft as a B2B company, boring enterprise stuff. But the Consumer Cloud Revenue Office 365 for you and me at home is up 29%.
That really stood out to me, too. That is surprisingly strong.
Why is that happening? Are people just that addicted to OneDrive, or is it that they can't leave the ecosystem?
I think it's ecosystem lock-in combined with genuine value. People want the cloud storage for their photos, they want the safety features, and increasingly they want those AI tools at home too. 29% growth in a consumer subscription product that has been around for decades is very rare.
It really is.
It shows that the transition to the subscription model is fully mature.
People just accept that they rent their software now. There's no going back to buying a disc at the store.
Completely. But, and here's the but we promised earlier, all this growth, Azure, Office, AI, it comes with a heavy price tag. This is where we need to talk about the AI tax.
The gross margin. This is my favorite part of the analysis because it shows the friction in the machine.
Right. Gross margin is revenue minus the direct cost of goods sold. For software, that's usually just hosting costs.
Yeah.
Total gross margin dollars are up, obviously. But the percent of the efficiency of every dollar earned decreased slightly for the Microsoft Cloud. It's now at 67%.
And usually with software, as you scale, margins get better, not worse. Once you write the code, selling the millionth copy is virtually free. That's the beauty of the software business.
Exactly. Software usually has infinite operating leverage. But AI is different. The 10Q explicitly blames continued investments in AI infrastructure.
We're talking about the physical stuff here.
Data centers, servers, energy, and specifically GPUs. The chips required to run these models are incredibly expensive, and they use a massive amount of electricity and water for cooling.
So, unlike the old days where you wrote Windows once and stamped it onto CDs for pennies, every time I ask Copilot a question, a server has to spin up and do heavy math.
Correct. The marginal cost of an AI query is significantly higher than a simple database query or a standard Google search. Every time you generate an image or summarize a document, Microsoft pays a tiny tax in electricity and compute time.
And the filing says operating expenses are up 5% too, specifically for investments in compute capacity and AI talent.
They are hiring the most expensive engineers in the world and buying the most expensive hardware in the world. They are essentially building the factory while they are selling the cars.
It feels like a land grab. They are willing to take the margin hit now to own the infrastructure later.
That is the bet. But the risk, and this is what you should really watch if you follow this space, is whether that margin compression is temporary or structural. Is AI just fundamentally a lower margin business than traditional software?
That is a scary thought for the tech industry. We're used to 80 or 90% margins in SaaS. If
Yeah.
AI drags that down to 60% permanently, the valuations across the whole sector have to change.
Precisely. It turns a pure software business into something that looks a little more like a utility, a high-tech utility, but a utility nonetheless.
Let's switch gears to the part of the Microsoft house that isn't growing, the leaky roof, the segment they affectionately call more personal computing.
Yeah, this segment is the drag. Revenue dropped 3% to $14.3 billion. It is the only part of the company that shrank.
And it's mostly gaming and hardware, right?
Yes, and it is not a pretty picture for Xbox right now. Overall, gaming revenue is down 9%, but the number that really made me wince was Xbox hardware revenue, down 32%.
A third of the business, gone, just evaporated.
It's a crash. The filing plainly says it's due to a lower volume of consoles sold.
To be fair, we are deep in the console life cycle. The Series X has been out for years. Usually sales dip at this point.
They do, but 32% is steep even for a late cycle dip. And usually when hardware dips, the company says, don't worry, we are making it up on software and services.
Right, the razor and blades model.
Exactly. But here, Xbox content and services revenue also dropped 5%.
That is the double whammy. You aren't selling the razor and you aren't selling the blades either.
The filing notes they had a tough comparison against a strong prior year of first-party content. Basically, last year they had massive hits like Call of Duty or Starfield driving the numbers. This year, the release schedule was just thinner.
It really highlights the volatility of the gaming business compared to the stability of the enterprise cloud business. One relies on hits, the other relies on boring, multi-year contracts.
And it raises serious questions about their hardware strategy in general. Surface devices aren't mentioned as a growth driver either. It seems like Microsoft is slowly becoming less of a device company.
But there was one bright spot in that consumer segment, oddly enough. Bing?
Search and news advertising, up 7%. And if you exclude the traffic acquisition costs, which is what they pay to get people to use Bing, it's actually up 10%.
Bing is quietly growing. Is that the AI integration working?
It has to be. The filing credits higher search volume. It's very plausible that Copilot and the AI integration into the Edge browser are actually driving people to use Bing more. It's finally becoming a viable alternative to Google for specific types of queries.
And Windows OEM revenue, the license fee Dell or HP pays to put Windows on a new laptop, that was up 1%.
Barely a pulse.
But the reason is interesting. The filing mentions Windows 10 end of support.
The forced march. Support for Windows 10 is ending, so corporate fleets have to upgrade to Windows 11, which means they're buying new PCs. It's a cyclical bump, not necessarily organic demand.
Okay, so we've covered the fake profit, the expensive cloud, and the dying hardware. Now let's get to the scary stuff, the risk factors. This is where the lawyers get paid to tell us everything that could possibly go wrong.
My favorite section, contingencies.
There is a number in here that is almost as big as their entire operating income. $29 billion.
Who's that tax man?
Who is asking for $29 billion?
The IRS.
Wow.
Yeah, they are auditing tax years 2004 through 2013, which is ancient history in tech time. But the IRS claims Microsoft owes an additional $28.9 billion plus penalties and interest due to intercompany transfer pricing.
Break that down for us, transfer pricing. It sounds like something illegal, but it's standard practice, right?
It's the classic multinational move. You develop IP in the U.S., you transfer it to a subsidiary in a low-tax jurisdiction like Ireland or Puerto Rico, and you book the profits there. The IRS is arguing Microsoft shifted too much profit out of the U.S. tax net during those specific years.
And $29 billion, I mean, even for Microsoft, that is a staggering amount of cash.
It is. Now, Microsoft is contesting it vigorously. They say they've already paid taxes on that money and the IRS is double counting. But It's listed as a significant contingency. It's a dark cloud that will hang over them for years as this fights its way through the courts. It doesn't bankrupt them, obviously, but it definitely hurts the cash flow if they lose.
Speaking of dark clouds, the 10Q also updates us on cybersecurity, and it's getting very specific.
It is. They explicitly mention the Midnight Blizzard attack from late 2023. This was a nation-state actor.
This was the one where they accessed email accounts of senior leadership?
Yes, they used a password spray attack,
Yeah.
and the filing confirms they accessed some source code.
That is the nightmare scenario. If you have the source code, you can find the vulnerabilities that literally nobody else knows about.
Exactly. But what's really interesting is how they frame the future risk. The filing explicitly warns that nation-state attacks are intensifying, and this is the key, that attackers are using AI to become more sophisticated.
So Microsoft is spending billions to build AI, and the bad guys are using AI to break into Microsoft.
It's an arms race. And the filing admits that the sophistication is growing, making detection much harder. It's a very sober warning amidst all the revenue cheering. It essentially says, we are fighting a war on our servers every single day.
And then there are the regulators. It's not just the IRS coming after them.
Europe is still a huge battlefield. The filing mentions the Irish Data Protection Commission, the IDPC. They slapped LinkedIn with a fine in October 2025 regarding GDPR and targeted ads.
It never ends.
It really doesn't. Microsoft is appealing, but it shows that the regulatory heat isn't cooling down. The bigger they get, the bigger the target on their back.
I want to touch on one last section of the risk factors before we wrap up. The AI-specific risks. We've seen generic warnings before, but these felt different this quarter, more mature.
They are maturing. The lawyers are realizing what can actually go wrong in the real world with these tools.
They list hallucinations.
Yes, inaccurate information. Think about the liability there. If Copilot tells a financial analyst to buy a stock based on fake data or gives a doctor wrong medical info, who is liable?
Right.
Microsoft is flagging this as a material risk to their reputation and their wallet.
And they also list copyright.
The copyright and IP claims regarding AI training, that is the legal battle of the decade. Did they train the models on data they didn't own? If the courts decide they did, the damages could be astronomical.
There was one more that really struck me. Over-reliance.
That was fascinating. The risk that users become over-reliant on companion AI systems.
It sounds almost philosophical, like a warning from a sci-fi novel.
It does, but it's a very practical business risk. Think about it. If enterprises forget how to function without Copilot, if the junior coders can't code without the AI, if the writers can't write and then the AI goes down or gets regulated away, the customer's business stops.
Yeah.
And if the customer's business stops, they might sue Microsoft.
It's like we're forgetting how to navigate a city because we have GPS on our phones. But if the satellites fall out of the sky, we're all just lost in the woods.
Exactly. Microsoft is effectively warning that their product might be too sticky, to the point where it creates a dependency risk that could eventually blow back on them.
So pulling this all together for everyone listening, we see a headline number of $38.5 billion in profit. It looks like a rocket ship, but when you deep dive, it's pretty complicated.
It's highly nuanced. You have to strip out the $10 billion OpenAI paper gain to see the real company.
And the real company is growing at a healthy 23%, but it's paying a massive AI tax in hardware and energy just to get there.
And at the same time, it is shedding its consumer hardware skin. The collapse of Xbox hardware sales is not a blip. It really looks like a trend.
And that's the thought I want to leave you with today. We see Xbox hardware down 32%. We see Surface struggling. We see Azure up 39%. Is Microsoft slowly exiting the hardware game entirely?
If you follow the money, it certainly looks that way.
Are we watching them morph into purely the operating system of the AI world? Maybe in 5 years, they don't make boxes. They don't make consoles. They just make the brains that run everyone else's boxes.
Look at the capital expenditures. They are buying GPUs, not building factories for plastic boxes. They are investing in the intelligence, not the container. The tea leaves are pretty clear on this one.
It's something for you to think about the next time you see a new Xbox, or, frankly, don't see one. That is it for this deep dive into Microsoft's Q2 2026 10Q. Think about whether this heavy spend on AI infrastructure will yield long-term profits or just become the new cost of doing business.
It's the multi-billion-dollar question.
It really is. Thanks for listening. We'll catch you on the next deep dive.